Let's give you a look at futures as we get ready to start the new year. Kind of where we left it in some ways, at least. Sarah, of course, was here all last week. Yeah, I guess it was a high note. From where my perch there, it seemed like there was a good amount of volatility last week, and we're continuing this week. You can see futures set up for a much lower open, or at least percentage-wise, much as 1%. European markets, they already have been down this morning. Really, it all started in China with that Purchasing Managers Index coming in at a number that we haven't seen in, well, year and a half, 2 years, middle of 2017, I guess. That 10-year note yield, Sarah, whoa, 2.6.
11-month low.
11-month low there. Doesn't seem that long ago we were at 3.2 and talking about moving higher from there. Let's get to our roadmap this morning. And, of course, it does start with a new month and a new year and that volatility remaining. Futures, as you just saw, pointing to another sharp drop at the open. This after that disappointing data from China fueling those continued concerns about global growth.
Not to mention government shutdown in this country, day 12. President Trump inviting bipartisan congressional leaders to the White House for their first meeting since December 22nd.
Plus the FANG trade, remember that? Well, it was a disastrous few months for those once high-flying tech stocks. What's going to happen this year? Are the bulls going to be rewarded? Well, it's not how investors who are long, at least this market, had hoped to start the new year. Futures, as you saw, indicating what would be a sharp decline at the open. This sparked by worries about a global economic slowdown. Data out of China showing contraction in factory activity for the first time in more than a year. Weak PMI numbers out of Europe also adding to what is relatively gloomy sentiment, at least when it comes to the hopes for global growth. Stocks coming off the worst year they've seen since 2008. As you probably already know, the S&P 500 was last year's biggest decline among the major three indices. And as you see, it was down 6.2%. NASDAQ also ended down, but not as badly. Let's
chat it.
Let's chat about it.
So that doesn't tell you the full picture, because if you look at groups like home builders, if you look at the automakers, if you look at the industrials, or if you look at the small caps, all performing significantly worse than the broader index, and you put all those threads together and sort of wonder what that kind of picture paints. Number one, global weakness was the story. All the international indices did a lot worse than the U.S. And those concerns obviously are continuing today with that latest China manufacturing number below 50. We got a PMI below 50 last Monday as well, which means that China's manufacturing is actually contracting. So that's the weakness potentially in the industrials, whether it's trade and everything else factoring in there. But you also had pictures of weakness in the U.S., like the small cap underperformance. And we're starting to get some regional manufacturing indices in this country. Richmond, Dallas, Kansas City, all coming in sharply below estimates. Wondering what kind of picture that paints for the U.S. economy, which is actually coming off of a fairly strong year. And the question is, how much is baked into this market in terms of recession, slowdown? Where are we actually going? Yeah, and as you pointed out, Sarah, the numbers themselves, while not good, of course, worse than 10 years for the S&P, nonetheless, some of the performance of individual stocks, a lot worse, some of the names that we follow closely. Also back to an area you follow closely, whether it be consumer, there I'm thinking more like Kraft Heinz and Conagra, which I watched, which I just saw last week continue to sell off. Interesting to note as we head into this year, concerns in high yield, not necessarily having anything to do with defaults, but simply the fact that 8% paper still doesn't seem to be something people want to step up to. And I do wonder whether you're going to start to see a continued focus from investors that we saw towards the end of last year on levered balance sheets and companies such as a Conagra, which loaded up to a certain extent on debt, and others that have done deals where they seem to be really suffering as a result if they miss numbers, as they did and others potentially have. Worries about cash flows when you talk about those levered numbers. I think you have a lot of competition for buyers of debt in 2019, and we're going to see how that all shakes out, because we got a lot of corporate refinancing coming due in 2019, and we're back to trillion-dollar deficits in the U.S. at a time where the Chinese haven't been buying as much of our debt. The Japanese haven't been buying as much of our debt. There's going to be a lot of competition out there. And we're going to see at a time where the Fed is tightening interest rates how this actually all plays out. Despite, what you mentioned, You mentioned deals. It was actually a very strong year for deal making.
It was
2018.
strong. First 3 quarters were certainly very strong. Interesting the way the high yield market did seize up towards the end of the year, so you couldn't really finance some certain things, got put on hold, especially larger leverage buyouts, of which there were a number contemplated as the year ended. But it's an area we're going to follow. And by the way, I'm sure one of our guests, if not both of them, are also going to be following, which is the credit markets as well. Let's bring in David Rosenberg, chief economist and strategist at Gluskin Sheff, and Lizanne Sonders, chief investment strategist at Charles Schwab. David, I'll start with you for what I know is just going to be some really ebullient views on the market this year and the hopes that we have for the economy. I kind of kid. It wasn't long ago you were sitting next to me talking about recession potentially next year, I guess. I assume
this year.
This year.
Welcome to 2019.
Right, thank you. Sarah's updating me on what year it is. Nothing has changed, I guess, over the last couple of weeks to change your view, David?
Well, no, nothing at all. I think that we have to operate on what we do know in 2019, because we also know that there are a whole host of uncertainties domestically and globally. But we know that the fiscal stimulus that gave us a couple of quarters of very good growth in 2018, we're finding out into year end that there was no multiplier impact from the fiscal stimulus. And we're going to go into 2019 with the stimulus becoming a fiscal hangover, as Sarah just mentioned. We also know that the peak impact of what the Fed has already done is going to end up having its peak impact in 2019 in terms of the impact it's going to have on growth, just as the tightenings in 2005 and 2006 had the ultimate impact in late 07, 08. Look for the cascading lagged impact of what the Fed has done to hit home on the domestic side of the economy in the coming 12 months. On top of that, what is the outlook for U.S. exports when the OECD leading indicator is down 11 months in a row? Not too positive. And we also know, and one of you had mentioned about what's happening on the corporate balance sheet. Remember all that debt that was taken on to fund those massive record stock buybacks. Well, 2019 represents the first year of 4 years where we're going to average, in my opinion, on debt servicing costs. Whether it has an impact on ratings and debt downgrades remains to be seen. But the debt service drag, albeit from very low levels, is going to have a big impact on capital spending this coming year. So if we don't see an outright recession, I think it's going to be the next rung up from that, which is an extremely weak economy for 2019. And you're seeing the analysts right now cut their earnings estimates in light of that prospect.
Nothing rosy about that view. Lizanne, how much of it is baked into the market already?
Well, I have to concur with pretty much everything that Dave said. Whether a full recession is baked into the market, probably not. I think a growth slowdown, we got down 19.8 on the S&P. That's a fairly common occurrence to get just up to that down 20% bear market borderline and then pull back. And normally it has been in conjunction with a pretty significant slowdown, not necessarily a recession, although that has happened as well. I also think that, a lot of discussion about the strength of the economy, particularly in the first half of the year and especially in the second quarter of the year, is being tied to tax cuts, when in fact, of that 4.2% growth, about a percentage point of that was soybeans. It was front-running the tariffs. So when we talk about the offset of negativity of trade to the benefit of fiscal stimulus, I'm not sure a lot of that strength we saw in the first half of the year was specific to fiscal stimulus. I think a lot of that was just the vagaries of trying to get ahead of tariffs. And I think that's why we're seeing now a rolling off of some of the boost you saw in the manufacturing sector as well, which first showed itself, as you said, Sarah, in the regional surveys, and I think will now be seen in the ISM data.
Yeah, but Lizanne, to the extent that the market has already anticipated that, what's an appropriate multiple at this point that you're thinking about for this year when it comes to the S&P, as we, not long from now, we're going to head into another earnings season and start to get some answers, at least in terms of what the underlying numbers look like?
I never think of an appropriate multiple in point terms. I think about the background environment, the fact that we have tightening financial conditions. Ostensibly, we're still in a rate hiking cycle. Both of those things tend to put downward pressure on multiples. I also think of valuation as much as a sentiment indicator as anything else. There are times where investors are simply willing to pay more for stocks. It is not really a sort of a technical indicator that is just based on macro or even micro fundamentals. So I think with earnings growth rolling over and probably more to go on the downside in terms of cuts, particularly because you're still looking at double-digit expectations for the energy sector. So I think we haven't yet fully reflected the current environment into next year's earnings in a macro environment that suggests downward pressure on multiples. That means that with earnings growth rolling over, you need multiple expansion, I think, to be supportive for the market. And I just don't think the conditions exist for multiple expansion without earnings doing a lot of that heavy lifting, which I don't anticipate.
So, David, on the plus side, the market has fully priced out any interest rate hikes from the Fed this year, and we're already sensing a change in tone, i.e. the Williams interview on CNBC. We'll get Powell speaking on Friday. And there are increasing hopes of a trade deal with China, not just from the tweets, but from the Chinese side as well. So how do you factor in those positives? Could it stem some of the bleeding here in the market?
Well, look, it's a pretty dangerous game to be, placing investment bets based on telephone conversations or based on dinners. I think we have to take a look at this trade war with the U.S. and China as a broader geopolitical war between a dominant power and another country that is trying to rival that dominant power. This is much more complicated, than soybeans and automobiles. So I don't think it's going to get rectified anytime soon. And even if it does, I ask the question, if trade is the only thing that is on people's minds, why on earth would the Russell 2000 be the worst performing market in the past year? It's in an official bear market. The Russell 2000 is a play on U.S. domestic demand. It has really nothing to do with what's happening beyond our borders in terms of trade disputes. And it's telling you about where the market is pricing in growth for next year. You mentioned about the Fed being priced out. Well, what if I told you that by the end of 2007, the Fed was in the process of being priced out? Would you then leap into the stock market on the first trading day of January 2008 because the Fed was being priced out? It's the reason that the Fed is being priced out. That is what bullish investors or prognosticators should be concerned about.
But we're not seeing those kind of credit conditions that we saw in 2007, 2008, David. I mean, yes, we're starting to notice some trends, but they're not indicating recession.
With all deference, I could have said that by the beginning of 2001, the market had priced out the Fed. Did you want to start buying the stock market in January of 2001 when the market priced out the Fed? In fact, in January 2001, the Fed was cutting interest rates intermeeting. So if you want to have a lesson in history, here's what the historical record tells you, is that you don't buy the market on the first Fed rate cut. You actually are better off buying the market on the last Fed rate cut than on the first one, because it is the reason why the Fed switches gears, which is either a recession or a real significant slowing in growth that cuts into earnings expectations that drags the market down over the intermediate term. I understand this is not about the banking sector this time. Lightning doesn't strike twice. No two cycles are the same. But to tell me that you're going to turn bullish because the Fed is being priced out, the market's been pricing out the Fed for the past several months. And the market has been wobbly and weak. And it's because of the reasons why the Fed is starting to walk back its tightening rhetoric. And that'll continue for the next several months or the next several quarters. And when the clouds part and we go into the next positive economic cycle and earnings cycle, and that could be a 2020 story, it'll be time to invest again. I mean, people say don't fight the tape when the Fed is, when the Fed is easing. People say don't fight the tape, and then on the other, or don't fight the Fed, and the other direction, it seems to go the other direction. But the situation here, Sarah, is that it's the lags that matter, and the lags what the Fed has done. I mean, financial conditions have tightened 175 basis points just at the end of September. The economy is going to be feeling that for the next several quarters.
David, let me give the last word on this rather morose conversation to Liz Ann. Perhaps she can cheer us up at the end here.
I don't know.
Well, I'd love to try, but the one thing I'd add about small caps, too, is, and we've had an underweight to small caps, if you look at the burst of energy that small caps got at the latter part of 2017 on the basis of tax cuts being a benefit, and then they got another little boost because of their domestic orientation when the trade war first unfolded, I think what is neglected in that analysis is the fact that a fairly large percentage of small caps are not profitable. So they didn't benefit from the tax cuts. At the same time, they're very highly indebted. So in this environment of weak credit, which I think absolutely has mattered for the stock market, I think that's what puts small caps kind of back on their heels relative to larger caps. And I think that's likely to persist at least in the first part of 2019.
All right. Thanks to you both. I think setting the stage for what I think are going to be a lot of conversations, Sarah, about balance sheets this year, something we did not talk that much about last year. Thanks to David Rosenberg, of course, and Liz Ann Sonders.